founding and managing partner at Tanto Capital Partners. Ozan, good to have you with us. I guess this could go two ways, and it's binary. We could see a resumption of kinetic military action, or we could potentially see a breakthrough. How do you, as an investor, piece together what could be two very divergent outcomes?
Good morning, Jumana. I think our base case is that even if the hostilities cease, Iran has proved that it can exact pain in the region by playing an asymmetric warfare. And therefore, I think the new normal that we're meant to price is one where prolonged conflict is likely to continue, and a world where we're going to see the impact of inflation come through to the markets over the next months or so.
On the impact of inflation, certainly there are signs that it's beginning to creep up. We're seeing it in U.S. wholesale PPI and CPI. There are green shoots of inflation beginning to show up in markets, in the data, I should say, but less so in equity markets. At what point do you think equity markets are going to have to start paying closer attention?
I think this is a major problem. Equity markets should have paid closer attention to this when the hostilities started, but the market is trading quite narrow. What worries me is that the participation rate in trading has gone down, and therefore investors are, if you will, hiding behind the Max 7 and pretending that things are fine. Things are not fine, because we're going to see the lag effect of this war. Even if the war stops today, it's going to be, again, a couple of weeks or months until the inflationary impact filters through to the real economy, and the market should really be trading this. Now, what we've seen over the past week and Friday in particular is that we don't necessarily have to have a single event for the sentiment to change, and that on its own is quite dangerous to me. I think we should be trading the current geopolitical and macroeconomic factors a little bit more carefully, Jumana.
Where do you see the opportunity to trade it, though? Because again, if you had bought $150 upside in oil, you'd be out of the money right now. If you had bought S&P puts, you'd be out of the money right now. So where is it likely to show up if you wanted to express that sustained inflation view? And I guess maybe bond yields is the answer.
I mean, bond yields look like they may be the answer, but I would not go long any bonds, especially the longer dated bonds. I don't see why any investor would want to put them in their portfolio, given so much uncertainty persists. The way I would want to play it is, again, look, if you take a step back, thematically, there are areas that we should place capital towards. Let's just take AI, for example. But the way to play the AI game, I don't think is necessarily going to be through the equity markets. We could focus on trying to play the infrastructure and the energy part of the AI game, which is actually much more grounded in reality and is likely to provide a longer-term hedge versus trying to go long again the Max 7 stocks. Commodities is quite dangerous. I think taking a step back and understanding who wins through this sort of a prolonged conflict is important. We're in a world where money market funds yield more than they did before. Granted, not as much as inflation perhaps, but maybe to have some liquidity and then go long innovation vis-a-vis the more infrastructure part of the innovation cycle is not a bad bet.
The other big geopolitical event last week, of course, was that high-stakes meeting between President Trump and Xi Jinping. And you fast forward a couple of days, and yes, we got a few agricultural deals, talks, reports of China buying those Boeing jets, a warning that came through from China on Taiwan. Would you say that this was a summit that moves the needle in terms of the global geopolitical power structure?
The meeting on its own wasn't a notable one from that perspective. But let's say one thing. This time next year, we'll be talking much more about Taiwan than we are doing right now. I think once the wars in both Europe and Middle East abates at some stage, what will remain is that strategic rivalry between US versus China, especially around semiconductor manufacturing, especially around Taiwan. Now, I don't think China really wants war. I think China's perspective is to try to kind of convince Taiwan that they belong within the Chinese framework. And obviously, it's not in the United States' interest to let that happen. And I don't see an obvious way to bridge that gap. Now, again, we're discussing US selling arms to Taiwan, which would be a deterrent of sorts. At the same time, we have witnessed through what's happening in Iran that you cannot bomb a country into submission necessarily, let alone an island. And therefore, given that if you will, the prize at play over here is semiconductor supremacy, I think we're going to hear a lot more about this, and I think we'll be talking about issues around Taiwan a lot more this time next year, Jumana.
Yeah, I think that probably is a fair assumption. Ozan Alcaral, Tanto Capital Partners founder, managing partner, thank you so much. Well, still ahead, we will talk rates and global markets with Dirk Willer.